Good morning and welcome to today's webcast, Why Companies Should Consider Key Disclosures Now. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Chris Gewain, partner in our Orange County office, and Alison Sellers, senior manager in our national office. And Chris, I'll turn it over to you to get us started.
All right. Thanks, Emily. Appreciate it. Thanks again for everyone for joining the webinar this morning. Definitely a hot topic, I think, across all of our industries here at Moss Adams that we serve. Going through the session objectives here today, obviously the point of the webinar here is to kind of walk through some of the key disclosures that the new revenue recognition model 606 will have in place here for non-public companies. And then some of the challenges entities face as they're kind of going through this process. Some of the things we're not going to kind of go into much detail regarding is the whole 606 model. Hopefully everyone's a little bit familiar with the 5-step process: identifying the contract, determining the number of performance obligations, determining the transaction price, allocating the transaction price to the various performance obligations, and then how to go about the 5th step, recognizing that revenue, whether you would qualify to do it over a period of time or at a point in time. And so as we kind of walk through some of the disclosures, I think keeping that 5-step model in mind, I think you'll see some of those things drive some of the disclosure requirements that we'll be talking about throughout the presentation. Also, keep in mind the new model really focuses on the transfer of goods and services to the customer, where the old model under 605 really focused more on a contractual model. And so I think, as you kind of listen through the presentation and some of the examples that we've included, you'll kind of get a sense for that's why the new pronouncement is requiring this disclosure. And at Moss Adams, I think one of the ways that we're looking at this internally and helping our clients through this process is really I would kind of call 3 different phases of kind of going through a new revenue recognition model at our clients. There's looking at it from a controls or processes standpoint and maybe help our clients with some tweaks that they need to kind of make to make sure their revenue recognition model is in line with 606. There's having the client either go about assessing the impact or helping them through assessing the impact of the model and quantifying that for ultimately to determine if there's a material impact on the revenue recognition model. And then lastly, the piece that we're going to be going through today in the presentation is the financial reporting aspect and the disclosures. And one of the reasons why we thought it was really good to throw together a presentation on this is the disclosure requirements. While a lot of people wait and do the footnotes of your financial statements at the very end of the financial statement engagement, the new 606 disclosure requirements really give you a good guidance for how deep and how precise that you need to get with some of the steps that you're going through at your companies with regard to this revenue recognition implementation process, because at the end of the day, you're going to need to be able to provide your accountants with that information to populate those footnote disclosures. And if you're getting a review, they would need to review that information, or if it's an audit, they need to audit that information. And so one of the things that we're seeing, I think, across our client base is some of the systems that are utilizing, they don't necessarily, they can't populate that information quite yet. And so helping our clients be mindful of these items as they kind of go through 2018, because starting in 2019, when this adoption is effective for private companies, they will need to begin to populate the disclosures. One thing to keep in mind, this is not a Moss-Adams requirement. This is a new GAAP pronouncement, right? And so all CPA firms, will be adhering to this new guidance as they're kind of working through the footnote disclosures in the future here. So, Emily, we have our first polling question. As most of these webinars have, you'll see throughout the presentation, in order to get your CPE credit, you'll have to respond to the various polling questions. So,
all right.
Thank you. Here's the first.
Our first polling question: where are you focused in your day-to-day operations? Owner, finance department, or other? And I'll give everyone a few moments to respond, participate. Click the button next to the answer you choose and hit submit. And let's
look at the
results.
Oh, go ahead, Alon. Not surprising, but most of the people that are on the webinar are obviously finance department personnel. I think when you kind of go through this pronouncement, one of the things that I think you'll see as you kind of work through it is whether you're in finance or operations, you're going to need the backing, I think, throughout the company to kind of get through this, because there's certain information just being in finance that will be a little challenging to get without having the support of your operational people or your ownership at the company. We'll move forward and right into the presentation here. So kind of quick how we got here. Under 605, there were several different revenue recognition methodologies, right, that companies adhere to depending on which industry group you specialize in. One of these may or may not be important to you. Personally, I work predominantly in the construction space, and so ASC 605-35 is what I've seen on most of my clients, and the thought being, hey, they want to centralize all these into one model.
Hey, Chris.
Yeah.
So I wanted to point out if you look at current revenue recognition disclosures, most companies have a pretty simplistic disclosure that may be just a short paragraph. Of course, clients that have long-term contracts may have some additional information. But if you were to currently look at the disclosure requirements under the current revenue guidance, there's actually no disclosure requirement just for the overall revenue recognition standard. And all the disclosure requirements are actually driven by these specific ones that are listed here. And then also on the next screen where it kind of goes into the industry-specific ones. So currently, there are multiple standards that speak to RevRec disclosures, but there's not one overall disclosure. So the new standard really helped, as you said, centralize these and kind of create one overall general disclosure requirement regardless of your industry.
That's a good point, Allison, and that's one of the reasons I think it's important to to get a hold of the disclosure checklist for the new standard. And one of the things we're doing as a firm is walking through those new requirements that are embedded in the disclosure checklist, because naturally we have a lot of clients that if it's not really required, right? Do we need to disclose this? Well, I think under the new standard, it's going to be required unless there could be an argument made in certain circumstances, maybe that it's not material, right? And so definitely something that we're trying to bring up, in our client discussions throughout the year.
Yes, but I think we'll touch on that as we wrap up, or as we continue through the presentation.
Right. So the goal of the new pronouncement, again, under 605, there were all these different revenue recognition models, right, for all the different industry groups, that are out there. And I think the point of the new model is really to have some consistency. If somebody was looking at a contractor and to try to compare that to a healthcare company or a real estate company, there'd be one revenue recognition model. So, there wasn't one methodology going for one industry group versus another industry group. So that comparability across industry groups, I think that was the goal of the new 606 model as well. And then Alison's going to get started here in the 606 presentation requirements.
Yeah. So before we dig into kind of the disclosures, I want to kind of step back just for a moment to talk about what you may see new on your balance sheets. Because what's going to be presented on the balance sheet that may be new from our current standard is going to drive a lot of these disclosures. The items related to a company's promised good or service that are in relation to the customer's obligation to pay for these good or services create contract assets and contract liabilities. And so that's what we're going to touch on first, are these newer balance sheet items that you may see. So the contract asset or liability, basically here's our technical FASB definition here. So it's going to be presented on your balance sheet, and it'll depend on the relationship between whether or not you've provided that good or service at a point in time and whether or not the customer has paid you or has an obligation to pay you at that time. While the guidance calls it a contract asset or liability, it doesn't need to be labeled exactly as that on your balance sheet, but if you do present it such as an item which many long-term contractors will have is a retention receivable, that is considered a contract asset. And so you would just want to make sure that in the financial statement disclosures, you're providing enough information and clarity so the users of the financial statements understand the difference between the contract asset and retention. And so one of the key distinctions is that it's the conditionality of whether or not you have the right to collect. So, and that's why with receivables and retention, this is a difference, and so which will impact many of the clients. So for a contract asset, that's the right to consideration in exchange for goods or services that have been transferred to a customer. And so with retention receivable, the idea is that right now that is a conditional right to receive those amounts that are due, because you will not be able to collect on that retention receivable until you've completed the project to the satisfaction of the owners. So that's a conditional right. Versus the account receivable is basically, it's an unconditional right for the consideration. So only the passage of time is required before the payment is due. So such as AR, you bill the client for the amount received because you've performed and you delivered the good or service. They have within their set payment terms to pay you. So you have a right to those funds, that cash payment, and it's only attributed to the passage of time until you collect it. So that's something to note that will be a difference, especially for long-term contractors. Additionally, then there's contract liabilities, which is the entity's obligation to transfer goods or services once you've received consideration from your customer and you haven't yet performed on your obligation. So this really isn't that different from current practice when you have unearned revenues from amounts that you've received payment that you've not yet delivered on. So those are items to keep in mind of new items that you may see differences on the presentation. So we now have another.
Alison, one thing I'd point out on that last slide that Alison was talking about, well, some of those things may seem like little nuances, right, whether it's considered a receivable or not. It's important that you have those discussions with your bank and your bonding company or your surety or some of the users of the financial statement that may be giving you credit for a certain amount as technically a receivable, and it may not technically be, like for instance in Alison's example there, the retention balance, while it's a contract asset, it would not be technically a receivable. And so nothing's really changed in your business, but maybe just get the wording tweaked potentially in one of your agreements with one of the users of the financial statements may be important there.
Yeah. And then since we kind of step back here, also the last one here for current and non-current. So similar to other assets and liabilities, if you present a classified balance sheet, you would need to determine whether or not the assets or liabilities would be recognized within the year or your normal operating cycle, or whether it would be a longer term than that. But yeah, that's an important thing to note, that a lot of this does play into what the users need to understand. Okay, so we're going to move on to our polling question.
All right, our second polling question: has your company began analyzing the impact of the new revenue recognition standard? Yes, we have completed our analysis. No, but it's in process. No, but we will start soon. No plans have been made yet. Or what new revenue recognition standard? And as a reminder, if you would like to receive CPE credit for today's webcast, you'll need to respond to at least 3 of the 4 polling questions. And this is our second question.
Okay. Well, I'm happy to see that there's almost a majority, I want to say, in the yes, we have completed our analysis, which is an amazing, and you should give yourself kudos that you're to that point. That's where we would hope everyone is. And then for those of you that are already in process, that's great. We imagine that many of our clients will be moving forward on this, especially if they are calendar year-end 12/31 reporters, that once they've completed their review or their audit for the 12/31 reporting period, that they'll move directly into kind of planning for this process. So for those of you that are not yet made plans but will start soon, hopefully that becomes your next priority once you're through this first quarter reporting process. So for the next bit, we'll go through the specific disclosure requirements. And this is where you're going to get to see really how much these standards are expanding the requirements. And we know especially for a lot of the privately held companies, typically the position has been to disclose kind of as little as possible to meet standards. And this new standard really will require that these disclosures related to your contracts with your customers are going to be expanded significantly. There are differences between public filers and non-public entities. So FASB did recognize that not all of the disclosure requirements should be required of non-public companies or private companies because the cost to provide them would really outweigh the benefits. And they also felt that users of private entity financial statements usually have access directly to the company to get supplemental information for the revenue cycle or information if they needed it. So that was some of the thought process between having the non-public entities not have the same disclosure requirements as a public company. So kind of saying that, so if you pull some of the public company disclosures that are going to come out in the next month here as they file their first Q under the new standard, if you look at all those disclosures, just note that while some of those are applicable to you, not everything is. So in the next bit, we're going to go over these 7 areas of disclosure requirements. So if you can see just from this list, these are the areas that will be requiring additional disclosures. So already it should give you a clue as to what's coming up next. So you have the information about your contracts. So in general, what are your contracts? Then disaggregation of revenue as appropriate. Contract balances, so that relates to your contract assets or maybe your retention receivable, your contract liabilities such as unearned revenues. Performance obligation, so that's what you've committed to in your goods or services to deliver. Judgments that you've made in determining how you're recognizing revenue or how you're allocating your revenue. And then there's certain accounting policy elections that you have to make when adopting this new standard. And then lastly, the effective date and transition method. So the overall objective with these disclosures is to provide sufficient information to understand, and these are kind of the important terms, the nature, amount, timing, and uncertainty of revenues, cash flows from contracts with customers. So to achieve that overall objective, the general disclosure requirements require quantitative and qualitative information in regards to contracts with customers, judgments made, and then any assets that are recognized in fulfilling a contract. And an important item here is really the focus on the qualitative information. Many companies have not disclosed that in the past in regards to revenue recognition, and that's a new focus with this standard. In meeting these disclosure requirements, the level of detail provided may vary based on the significance of each of these items. The disclosures can also be aggregated or combined, or aggregated or disaggregated, depending on what's most useful to your financial statement users. So with the contracts with customers, you are required to recognize the revenue from contracts separately, and generally most companies already present their revenue from contracts separately on the face of their income statement. So that's presented there. If you aren't presenting it that way, you would be required to include additional disclosures to break that out. But I think most companies will already have that presented on their income statement. And then separately are any impairment losses. But these are impairment losses related specifically to any receivables from your contracts with customers or any impairments on potential contract assets that you've recognized. So those items, if they're not presented separately on your income statement, would require additional disclosures. All right, Chris, so I'm going to pass this back to you to discuss the disaggregation of revenue.
Thanks, Alison. So as Alison mentioned, one of the new requirements under 606 is to disclose your disaggregation of revenue. And so what does that mean? Well, a couple things. Under the 606 model, if you kind of go back to the standard, that fifth step is how to go about recognizing revenue. And there's two options under the new model that you either would recognize revenue at a point in time or over a period of time. That's not an optional election. There's certain qualities that your revenue recognition stream and your business have to meet to qualify for one or the other. But you would need to disclose the amount of revenue that's recognized at a point in time versus the amount of revenue that's recognized over a period of time. And so that's what that first bullet point is alluding to there with regard to timing of the goods or services, because you may have different answers if you have multiple different types of revenue streams at your company. The second bullet point there, as Alison alluded to earlier, is the qualitative information about the economic factors, the economic factors of your business. And so, working heavily in the construction space, some of the things I think about when I think about economic factors, obviously, is your type of customers, your geographical information about your customers, and also maybe your type of contracts that you're entering into, because there may be multiple types of contracts in your business that you're entering into on a day-to-day basis. So on the next slide, you'll see some more qualitative examples. And so I think one of the things that I think a lot of my private clients are going to struggle with is this is a new type of disclosure for them, and thinking about it qualitatively, how do we go about doing that for our business? Well, I think going about and thinking about how your users of your financial statements really look at your business are important. And so one of the things that I would recommend doing is if you have some competitors or comparable companies that are potentially publicly traded companies. Historically, publicly traded companies have what's called an MD&A section that's attached to their filings, and you can see within there a lot of times they've always disclosed information about the end user markets that they serve. So I think information, similar to that will be important. Also, public companies have things like earnings releases that are out there that they disaggregate the revenue in those respects. So I think you can pull examples with how larger companies are looking at their revenue streams in that way. Also, I know a lot of my private companies, they still have board meetings. And so a lot of times when you're having a board meeting, you're breaking things down at a lot more granular level than you have in your financial statements. And that may be a way to present things in these different fashions, as well as how your chief operating decision maker of your company, a lot of times your COO or your head of operations, how they're looking at the business and how they're evaluating what type of work the company should be investing in versus another type of work, or what type of contracts the company should be getting involved in versus other types of contracts. So I guess there's not going to be a one-size-fits-all answer for every company. I think you're going to have to take a kind of a good hard look at your business and what you're trying to convey that you do for your customers as part of your business. And so one of the things that we thought would be great for our private companies to see is, hey, so great, these are great things to know. Well, what's that look like, right? What's this footnote disclosure for disaggregation of revenues? Can you give us an example of maybe what this would look like? And so on the next slide, you will see kind of some verbiage that's together here. The first paragraph that's in there, you can kind of see an example of a company that's recognizing revenue in two different revenue streams, right? One that's over a period of time and one at a point in time. And so you can see that first paragraph kind of explains how part of their business is done in one manner versus another, as we talked about earlier. The second paragraph goes into a point in time and why that's different than the portion of the business that's recognized over a period of time. And so again, just an example so you can get some visibility to see what that new disclosure would look like and how you're conveying that to the users of the financial statements. The next slide here kind of goes through and shows how your revenue streams, some of the more, I say, different types of work that you're doing, some of those end user markets, if you're operating and doing different types of work, how that disaggregation would look. So again, not something that's going to be it's going to be different for every company, but again, I think a table like this would be a real easy way to kind of show the different types of businesses that your company serves. And then one final example here is the different types of contracts that your potential company could enter into. And then you'll see the paragraph below kind of talks through real briefly some of the different risks that each of the types of contracts that you enter into would have. And that's why one of the reasons why I think disaggregating the revenue in this manner makes a lot of sense, because a fixed price contract, for instance, would have a lot of different risks versus a cost reimbursable contract, for instance. So just again, some food for thought as you kind of go through and think through your disclosures, but just some examples of what maybe that disaggregation of revenue would look like. Again, a lot of my clients do some public and private work, and here's an example of potentially something that could, how your footnotes could look like from a disaggregation of revenue standpoint if you elected to do it in that manner. And Alison's going to kind of go through here and start talking through some contract balance disclosure requirements.
Yep. So for the next one here, contract balances are regarding the opening and closing balances of the receivables or contract assets and liabilities. For most companies, these items are on the face of the statements because they're presenting a comparative financial statement, so they can see the balances as of 12/31, let's say 2018, compared to 12/31, 2019, if you were doing a comparative period upon adoption. However, if you present a single year presentation, those items would need to be disclosed separately, and it doesn't have to be a tabular format. It can be in a written narrative, but you would want to disclose the amounts as of the beginning of the period to the end and what those differences were. I will say under current accounting, entities with construction contracts or other long-term contracts already have disclosures on unbilled receivables or deferred revenues. So this may not be something that's really new for those that currently have those types of disclosures. But with this standard, it's now required for all entities to include these items. So if you haven't in the past presented more disclosure regarding some of these contract assets or liabilities or receivables, this could be an area of expanded disclosure requirements for you. So this slide here gives you a footnote example of what you may have in your financial statements depending on your revenue recognition process and your customer base. And you could read through this and you'll see that it highlights the nature of a company's receivables, the contract assets and liabilities, as well as it goes through the differences in the billing process and the revenue recognition process based on the significant disaggregated revenue streams. So for this example, consistent with the previous ones we've been looking at, they've separated disclosure regarding the public work group as well as the building group. And they've identified within the building group that they often received advanced deposits from their customers and discuss how those items are recognized in revenue. Another separate disclosure that you'll see at the last paragraph here is that there are amounts earned during the period that were previously unearned or a contract liability. So they're disclosing amounts that were in the prior period a contract liability that were earned during the current year. So that's a new disclosure for most companies. The other item of disclosure is performance obligations. So this is a new term within the new standard, and it's basically what goods or services have you promised to deliver within the contract. It could be that you have multiple performance obligations, or it could be that you just have one item. To help the users of the financial statements really analyze the nature, amount, timing, and uncertainty, if you remember those terms from when we started, of revenue and cash flows arising from contracts with customers, these disclosures are required for these performance obligations. Private companies are required to disclose when they typically satisfy the performance obligation, so when they have provided that good or service. What are the significant payment terms from your customers? What is the nature of the goods and services? So what type of items are you providing? Are you doing engineering services? Are you providing architectural? Are you doing construction management? Are you the general contractor or a subcontractor? Those items. And another item that's important here that will apply to some of our construction companies would be warranties that may be in place. So those are all different items that may have additional disclosures. So for when a performance obligation is satisfied, so for most of clients, it may be upon delivery or as the services are rendered. So for long-term contracts, this could be a cost over cost basis. So how much cost have you incurred over your estimated cost to complete? So which is very similar to our current percent of completion. You may have more of a milestone recognition, or it may be a short-term contract that you're not satisfying that performance obligation until you've completed the service. So these are items that are the significant payment terms that you may have to include when your payment is typically due. If there's variable amounts of consideration, so if the potential amount of revenue you're earning could fluctuate based on some variability in the contract, or whether there's constraints or limitations on the total amount of revenue that you may earn. Those items would need to be disclosed. The next piece is revenue recognized in the reporting period based on performance obligations satisfied in previous reporting period. So this really translates into if you have items that you recognize in the prior period related to, let's say, a contract, and then there were contract modifications or change orders made subsequent to the recognition of some of the other performance obligations related to that contract, you then have a change in your transaction price, and you would need to disclose how much of your revenue recognized is actually related to those contract modifications. So in this,
Alison, that's really no different, I guess, when we think about 605, if we had a significant change in accounting estimate, right? Very, very similar, right?
Correct. So, yeah, so there may be within some industries it may not be a significant impact to their current disclosures. So for this footnote example, going through the performance obligations, it talks about what the performance obligation is, whether or not they have one performance obligation. So if they are providing one overall construction of a building or an overall design of plans to a customer, or if there's multiple performance obligations, so if there's different segments that they can break out between, so there's different product life cycles or different phases of a contract that may meet the conditions to be a multiple performance obligation. They're required to disclose the transaction price of those items, and if there's multiple performance obligations, how they've allocated that. And then they also would require disclosure of how they've estimated the selling price for when there's multiple performance obligations. A lot of construction contracts will be able to identify that there's only one overall performance obligation, so the information regarding multiple performance obligations and estimating the standalone selling price would not be applicable to those entities that have only contracts with primarily one performance obligation. The next example goes into a little more detail regarding the contract modifications, or as you may want to consider, change orders, and discloses the amount earned in the current period for those changes to the contract. This is an example of the disclosure that may be very similar to what you currently have for changes in estimates, as Chris pointed out. So Chris, I'm back to you now regarding the significant judgments. And I think this is really an area that is a new requirement that will take some time getting owners and users of the financial statements comfortable with this information.
Thanks, Alison. Yeah, if you go back to the 606 model kind of holistically is, I would say, a lot more principles-based. And so just inherently in the standard, there's a lot, since it's going across multiple industry groups and trying to combine multiple different revenue recognition models that prior standards kind of took care of, there's a lot of judgment, obviously, as you're going through and figuring out what you need to disclose. And so one of the things that is required is disclosing some of those judgments that you make along the way. So we'll get into maybe what some of those things would look like potentially for some of your companies. So significant judgments in the application of 606. So performance obligations satisfied over time. So how do you go about making that determination about how revenue is recognized over time? And then constraints to variable consideration. Those are two areas where there's naturally going to be a lot of judgment involved in how you're recognizing revenue. So with regard to the performance obligations over time, non-public companies must disclose the method used. So that's a lot of my contractors, for instance, it's not going to be very challenging. You can utilize a lot of different input or output methods. A lot of my contractors, if they're currently under 605 using percentage of completion method of accounting, they're going to most likely just transition over to an input method to recognize revenue over time using a cost-to-cost method. And so again, I think you're going to come up with a very similar answer, but you're going to need to disclose that a little bit more, maybe transparently under the new standard versus the old standard. And then you're going to need to also add in some of the qualitative information about the methods and inputs and assumptions used as you went through the process of determining whether to include or exclude variable consideration in your transaction price. And so that's going to be a little different than using what we've seen probably under the 605 model a lot of times, where you have your general accounting policy footnote. This will be a little bit more granular and kind of call out some of those judgments that you made in making those determinations if they're included or excluded in the transaction price. So on the next slide is a quick example. You can kind of see the first paragraph is an example. If you're using the cost-to-cost method, for instance, to recognize revenue over a period of time, like a lot of contractors under 605 currently do under percentage of completion, is an example of what that may look like. And then the second paragraph there is an example of some of those variables that they're considering as part of that estimating process of that total estimated costs as they're measuring their progress over time of delivering that service to the customer. The next slide is more of the variable consideration disclosure that we were referring to. So again, go back to the third step of the 5-step 606 model. And a lot of times, in various businesses, these come in different forms, but in construction, for instance, if you have an incentive fee or a claim that you may or may not have, or a discount or an unapproved change order, there's now set ways under the 606 model that you have to go about estimating that amount. And then after you go about estimating that amount, evaluating that amount against what's called that probability constraint, And if it meets that probability constraint, then you would include the amount in the transaction price. If it doesn't meet it, you would not include that in transaction price. And so there, again, there's going to be a lot of judgment, and I could easily see one company taking one position and another company taking another position. And so I think the disclosure just needs to help the user kind of understand the thought process there. And so in this example here, there's an example of, for instance, claims and incentive fees and how the company went about going through the thought process of including that in the transaction price for their company. This next slide, I think, going back to the judgments, this is again, if something were to have changed, I think Alison kind of alluded to this earlier. If something were to change, obviously, in your variable consideration judgment year over year, that may cause you to accelerate revenue in a particular period or decelerate revenue in a particular period. And so giving that true indication to those folks that are looking at your financial statement of what service was actually provided during the period and the revenue that should have been recognized, knowing all the facts that you do now, needs to be a little bit more transparently disclosed. And so again, here's kind of an example of that. And then again, just another example, if you have a change in some of the variables of your performance obligations and how that may change something that maybe you previously recognized. That needs to be a little bit more transparently disclosed under the new model versus the old model. One thing to think about with all these disclosures, especially when we're talking about dollars, is materiality. So if there isn't really a material change, maybe some of these disclosures may not need to be made. That being said, you're going to have to show your accountant why you came to that conclusion, right, and why that amount is not material and it would not need to be disclosed. A lot of these things are qualitative that I know Alison went over earlier, and so I think that'll be a lot harder to make that argument versus some more of these quantitative ones that we've talked about over the last couple slides.
Great. Thanks, Chris. As I stated in the beginning, there are some accounting policy elections that companies will need to make, and typically the accounting policy elections are disclosed in the front of the financial statements, usually footnote 1 or 2 typically. So these are items that would need to be disclosed. Shipping and handling may not be a large part of your business based on the industry groups that we have on today's call. Sales taxes, though, may be an area. So typically if you have value-added taxes, business B&O taxes, business operation taxes, you need to determine how those are presented within your financial statements and how those are accounted for. Whether it's net of sales or presented separately, which I think is pretty consistent with today's standards. The other item that you may want to include the accounting policy election is the loss contract unit of account. And what this is speaking to is whether or not you're recognizing a loss on a contract unit of account by a performance obligation level. So if you have multiple performance obligations, and you recognize within one performance obligation that you are going to have a loss for that item, you may be recognizing that loss at that performance obligation level, or you're recognizing the loss on a contract at the overall contract level. I would expect to see most companies probably continue with the overall contract level, but that definitely is probably a newer item that would need to be considered as an accounting policy election to be disclosed. And in regards to the no specific requirements on the loss contract unit of account, There isn't a specific disclosure requirement, but I would highly recommend, especially if there are significant losses within your contract schedule, that you would want to disclose what the unit of account that you are using to calculate that loss. The next item is that the standard does provide many practical expedients. So this was the FASB, so the Accounting Standards way to kind of help with this implementation process and maybe make it a little less cumbersome. So these items are significant financing components, so whether or not there's some sort of financing within the terms of the contract. If there are financing components, but it doesn't go over a period of 1 year, you don't need to adjust the transaction price for any embedded financing components. Cost to obtain a contract. So if there were costs that you incurred specifically to obtain the contract, you can expense them directly versus capitalizing those amounts when the amortization period, so basically the term of the contract, is less than 1 year. The portfolio approach speaks to when you have numerous contracts that are very similar in nature, you can generally group those together in one portfolio of contracts to determine the revenue recognition process. And then lastly is whether or not you're recognizing the revenue once you have a right to invoice the customer. So many of these may not specifically impact some of our long-term contractors that have that, but there may be some other areas that could impact within professional services, hospitality, and those types of entities. So we have one last polling question, I believe. This is number 4.
This is actually number 3.
Oh, number 3.
We're squeezing in 2 more polling questions. Here's our third one. Who is the new revenue recognition standard going to impact the most? Your options are my outside CPA, operations, finance or accounting department, the owners, or we are all in trouble. I'll give everyone a few seconds to respond. For those of you that would like a copy of today's slide deck, you can download that now from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast.
So I'm laughing at the skewing here. Finance and accounting department is most recognized as will have an impact. I will say as a public accountant, a CPA, I feel that I'm going to definitely feel some impacts on this. And then I'm sure the owners won't feel the impact of the adoption, but they will definitely recognize it as they kind of see the impacts to the financial reporting. While, as Chris has pointed out, your overall business, of course, isn't changing, but there definitely are some nuances into some of the presentation and disclosures. And I will agree that we're all in this together. So as we'll make it through the next 2 years, and then we have lease accounting to go through. So we'll get really familiar with each other as we work through those adoptions. So as we kind of head to the finish line of our presentation today, we're going to go over the effective date and transition disclosures. So public entities, so that's generally publicly traded companies. There are some other entities that fall under this definition, but for the most part, those are your publicly traded companies. And they will be adopting this standard basically in periods beginning after 12/15/17, so they have already adopted the standard as of 1/1/2018, and so we're expecting to see in their financial reporting, if they're a calendar year end, for the first Q financials that they release, they will have the financials presented under the new standard as well as disclosure requirements. So we will definitely be watching for those to come out and gleaning information we can over the disclosure requirements. For non-public entities, we have a grace period of 1 year. So if you're a calendar year-end reporter, you would not need to reflect the adoption of the standard in your financial statements until 12/31/2019. However, you need to be mindful that while you're not going to have to report it externally till the end of 2019 if your calendar year end, you do need to have your systems and processes in place to make sure you're capturing the information necessary to appropriately report this information for the year. So there's two methodologies for adoption. One is the full retrospective, and basically that one means that you're going to adjust to the earliest year presented. So if you have a comparative balance sheet and you're doing your 12/31/2019 financials and you're comparative to 2018, you would be adjusting your financials as of 1/1/2018 so that way the 2 years are comparative. So that's the full transition or full retrospective method. And then the other option is a modified retrospective. So for that one, you would not adjust your 2018 on a comparative basis financials, but you would only adjust the 2019. So in that year, you're not going to have really a comparative basis. You're going to have one column that's under the legacy GAAP or the old standard and one column under the new standard. However, it may be easier to do this modified retrospective adjustment versus the full retrospective. But that is something companies need to consider and discuss with their stakeholders to see what method they would prefer to adopt. There are some practical expedients allowed within the full retrospective to help ease that transition. So contracts beginning and ending in the same annual period don't need to be restated. If you have variable consideration, you don't have to pretend that you estimated at the beginning of a contract. You can actually look at the actual prices that were recognized. And then if a completed contract has been completed before the adoption period, all of that revenue would be recognized under legacy GAAP. There's the details of the full retrospective. So the cumulative effect for contracts in process, you need to identify all the performance obligations in existing contracts and recognize or determine which ones are unsatisfied at the time, what the overall transaction price, and how you need to allocate that transaction price. The footnote disclosures in a full retrospective would be for all periods presented. So same thing, you would have that on a comparative basis. And then you also disclose, of course, the accounting change that you've electing, basically adopting this new standard. For the modified retrospective, as I said, the prior period will be under what we currently recognize. So you're definitely going to have a lack of comparability between the two in that adoption method, but it may be a more simplified method for everyone. And then the footnote disclosures consistently with kind of the presentation of the financials, you're going to have 1 year of disclosures under current standards and then 1 year of disclosures that are required to meet the new requirements under ASC 606. So if you did a modified retrospective basis, the statements may be a bit cumbersome to read, but it may be a simpler adoption process. And to wrap up the hour, I'm going to pass it back to Emily with our last polling question.
All right. Our final polling question. After hearing this presentation, I am not worried. We have this under control. May need to get some external resources to assist my accounting department in evaluating the impact. Hoping my CPA will figure it out for me. Or we have the new revenue recognition standard locked down. I'll give everyone a few moments to make their final selection here. We are running up right to the top of the hour, so we won't have time for your questions live. However, we'll be happy to follow up with you after the webcast. And let's see what everyone.
Alison, one point you brought up. One point you brought it up on the presentation with regard to the disclosure requirement. This will be considered a change in accounting policy, right? And so the disclosure, when you convert over to the new model, you'll have to disclose what that impact is, right, in that year of adoption?
Correct. Yes, you will.
So you would almost have it under, you would need to know the answer under the old revenue recognition model versus the new revenue recognition model, right, to be able to know that impact, correct?
Yes. So you kind of have to not keep two sets of books, but you have to understand the impacts for significant impacts. Okay, so we appreciate everyone's time today. I'm really impressed that so many of you, 40%, say that you have this under control. That's fantastic. I fully recognize that there are others that need some assistance, and hoping the CPA will figure it out for you. We'll be happy to work with you and kind of work through this process together. Thank you so much for attending today. Is there anything else, Emily?
Yep, I'd have some closing comments on how everyone can get their CPE, and thank you, Chris and Allison, for a great presentation. You guys certainly covered a lot of material, and while we didn't have time for questions live, we'll be happy to follow up with everyone after the call. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download this now. A copy of your CPE certificate will be emailed within 2 weeks should you have any difficulty downloading it today. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.